Okay, good afternoon. In this video, I'll be talking about how you as a real estate investor can invest in a hot, challenging real estate market. And today's video actually came from a comment from Tish. Tish commented on Facebook. So whether you're watching on YouTube, Facebook, Instagram, I want to hear from you, and this will give me ideas for future videos. So I want to know what you guys want to learn about or any questions, concerns you have, because it's going to give me some really great ideas to bring you more and more videos about real estate investing. And if you do have questions about real estate investing, head on over to callseth.com, and I want to chat with you for about 20 minutes face-to-face via a Zoom call and learn about your real estate investing goals, and maybe we can set you up on your own path or maybe on some of the deals I'm working on right now. So how can you invest and purchase in a hot real estate market? And as you can see, I tried adding some sizzle to hot. I'm not sure if it worked out so well, but hot is sizzling right now. So before we get into some strategies and all that stuff, we really have to understand, I'm going to really simplify this down. So I'm going to say, even though I might get roasted a bit, but I'm going to say there are two types of real estate markets. We have cash flow markets, and we have appreciation markets. Now, each real estate market is unique in itself, and then in that market, there are sub-markets. I get that, but for the sake of today, we'll talk about cash flow markets and appreciation markets. So cash flow markets, generally speaking, are going to be very steady in terms of value. So you might, if you're looking on a graph, it might just be steady like this, a gradual increase, but you're going to have higher cash flow. So the rent to value ratio is going to be up here. Now, appreciation markets, these are going to be your major city centers. So think New York, Seattle, Vancouver, Toronto. And Tish, she's in the Greater Toronto area, so I'm pretty sure she's thinking about the Toronto market. So what happens in an appreciation type of market? Well, you have a lot more competition because everybody wants to be there. You have a very solid job base. You have a diverse range of jobs available. You have an influx of population. Everybody wants to move there, so that's going to push values up. It's also going to decrease vacancy, which is also a positive. But what are some of the things? Well, we have higher prices. So like I said, in a cash flow market, you're going to see a gradual increase. Nothing to get too excited about typically in the cash flow market, but in a more appreciation market, a major metropolitan center, you're going to have periods where the property values increase, then you have a slump, and then it'll increase again, slump, increase again. But the rents will be a lot tighter. What I mean by tighter is they're going to have less spread between the ratio between the property value and the rents. So we're talking about rent yields. And this is because there's more competition, more people are willing to buy, and because they want to get into that market because the fundamentals are so sound, the investors are willing to take a lesser return in order to get into the market because they deem it to be more stable. This goes into our cap rate discussion if we're talking about commercial properties, and I've done a whole bunch of videos on cap rates and the effects on different types of markets and all that stuff. So just for today's purposes, we have cash flow markets. Think more cash flow, less increase in appreciation. But in an appreciation market, you're going to have a lot less cash flow, and even people are buying negatively geared. So that means the property is losing money because they're banking on that long-term growth. So this is what we're talking about when I say cash flow market and appreciation market. And again, I understand this is a big generalization, but it'll get this through. It will get us through the video today. So if you have any questions about cash flow, appreciation, real estate investing, go to callseth.com and we'll set up a quick call. So what are some of the strategies? And I think for Tish's question, she was thinking more, single family home type of thing. I know I talk a lot about multifamily investing. So today I'll concentrate more on the single family side, just to make sure I cover everything Tish was wondering about. So what are some of the things that we can do to get into a very tight market like a Seattle, Vancouver, Toronto, or a New York type of market? Well, we know that if we're just buying a single family home and putting a tenant in there, it's not going to cash flow. The numbers do not work in these types of markets. So we have to get creative. And I firmly believe there are deals in every type of market. You just have to put your thinking hat on and think outside of the box. So one good way would be secondary suites, also called granny flats, basement apartments. So basically you're taking, let's say, a single family home, a bungalow, and with the basement, side entrance, add a secondary suite in there. And this is going to really help out your cash flow. Let's say you're renting out one property for $2,000 a month, the whole house. Well, maybe you can have upstairs at $1,700 and somebody paying $1,500 in the basement. Sure, you're going to be investing some more capital into the home, but as long as you do things right, the value's going to go up. Maybe you can do a refinance after you do those improvements, and then you can ride the increased cash flow. And especially in these tight markets, getting an extra, $300, $400, $500 a month in cash flow means a lot because things are so tight, especially right now. With where we're at in terms of the market cycle. So that would be an option. The other another option could be do a big value add. So you're looking for, let's say, an original owner and everything looks like it's from the 50s. You can go in and really renovate the property, bring it up to snuff, and then place a tenant in there. But after you've increased the value, you would do a refinance, and then that way you can ride it out with your tenant in there. So doing these key renovations and not going over budget, obviously you're going to have to look at what the market's telling you, what are similar properties selling for. You can use the comparable approach. Again, we do lots of videos. I've done lots of videos on the comparable approach and find out what sort of upgrades are necessary to add to that property in order to get that value up there. So that would be another option. And then you have to get really creative with how you're sourcing deals. Maybe you know a friend whose one of their parents just died and they have this house that hasn't been updated. You need to jump on those types of situations and add that value. Lot rezoning. Maybe you can buy a property, rezone it, and then go to sell it. Lots of people have been successful with that, especially in hot markets. Maybe you can subdivide a lot. So let's say there's a property, it's on a double wide lot. Maybe you can sever the lot, sell this half, get a big chunk of change for that, and then maybe pay off some of that mortgage, or maybe you can buy an additional property with the revenues from selling the lot after you've gone through the severance process. These are all things you really have to get creative in these hot markets to find those opportunities, but trust me, they are there. Maybe you're taking a single family home and knocking it down and building a triplex. I actually just had somebody on my podcast, Purchase to Profits, who did that in Toronto, so a major metropolitan center in a very hot market right now. Knocked down the house and built a triplex, custom built triplex. And he made a pretty penny doing that because he chose the right location, did things the right way, and really came out on top. So people say, oh, it's a hot market, it's Vancouver, oh, it's New York, it's Seattle, it's Toronto. Well, people are making money in these markets. It's just a matter of thinking outside the box and seeing opportunities that many people don't, because so many people look at real estate investing and think, oh, well, I just buy a house and then I wait for 20 years and then it appreciates and then the tenant's going to pay down the mortgage. Well, that's the appreciation aspect is part of it, especially in a more appreciation type market. But there's also the other factor in terms of using your mind and your brains and finding these opportunities to add that value. And that's going to really push your portfolio forward. So another option I'm going to throw at you, and I know I'm going to piss off some real estate agents here, but another option, if you're in a really tight market and you can't afford to buy a home, like Tish was saying, finding down payments is tough. Well, don't buy a house. Rent a house where you're living. So let's say you're in a major metropolitan center, rent a house, and then buy a property in a cash flow market. So maybe that's 2 hours out of town, 3-4 hours out of town. There are cash flow markets around every single major city center, every metropolitan center. So I know a number of people doing this right now, very successful real estate investors. They're renting properties right now in these major cities, and then they're building their portfolios in more cash flow type markets where the cash flow, the yield of the property is a lot higher. Maybe there's more opportunities, less competition, but they're still looking for those solid market fundamentals to make sure that they're purchasing in the right spot. So this is definitely an option. Rent. There's no law or rule out there that says you must buy a house and live in it where you're living. You can rent and then invest in another market where you're going to get a lot more cash flow. And like I said, I've interviewed many people on my podcast who make a lot of money in these appreciation markets, but I also interview a lot of people who are making a killing in cash flow markets. It's all understanding the market, knowing exactly what you're dealing with, and then kind of changing up your strategy a bit to suit the market conditions. And option number 3 is go bigger. Now, this is where I get a little bit excited. But go bigger. So I've been talking about single family homes and adding a basement apartment, that triplex, fourplex, that sort of thing. But go bigger, because I'm going to talk about some economies of scale. So let's say you have a single family home. If you have a property manager managing this property, they'll charge you probably 12% to manage this property. But let's say you have 20 units, or let's say you have 50 or 100 units. What's your cost of property management at that point? Well, over here you get cut in half, and then down here you're looking at maybe 3 or 4%, depending on the type of property and all that stuff. So the economies of scale work in your favor as you add more units. Also, maintenance. You have one roof here and all that stuff. Well, over here you still have one roof with 20 units most likely. Here you only have a handful of roofs, or roofs, depending on which side of the country you're on. All this stuff, here you definitely have on-site staff, you have full-time maintenance people. This really helps out in terms of economy of scale, bringing down those expenses. Plus you have the additional benefit of having all these tenants, 20 different tenants. Single family home, one tenant, they move out, cash flow goes to 0. I don't care what type of market you're in, your cash flow drops to 0. But here, one tenant moves out, you still have 19 occupied units, the world isn't ending. Over here, you have 10 vacant units, the world is not ending. This is just a matter of doing business. So if you have questions about this, just head on over to callseth.com and we'll have a quick chat. So think about going bigger if you're in a tough market, because adding more units, your cash flow goes up, you're getting better debt terms. Banks actually want to lend money on these commercial properties because they're a lot more stable. They're operating as a business. It's not just one house with one tenant in there. So you get more favorable terms from the banks, from lenders. That's definitely a positive. I said you have economies of scale with all these things. Let's say you have a contractor, you're renovating units. Let's say you're renovating 15 units. Don't you think your pricing is going to be a lot better than renovating one? Absolutely. And then, depending on the type of property, but most of these you have, let's say 3 or 4 different floor plans. Once you know your floor plan, you know exactly what you need, and it makes planning a whole lot easier. But when you get into these larger properties, there's something that you will need, and it's called capital. Because if you're buying a 50-unit property, unless you are rich, you won't have the capital, so you'll have to start raising it from other people. This is another skill set, and then you will have to go in and partner with other people who have the experience. But there is a way that you can invest in these large commercial properties, these multifamily properties, without the capital to take down the whole deal and without the partnerships, and it's called syndication. So what syndication is, it's really a pool of investors, so all these investors will pool their funds together. These investors don't, sometimes they have real estate experience, but oftentimes they're busy, working their full-time job, being doctors, lawyers, all that sort of stuff, doing their full-time gig, and that's what they're experts at. They'll pool their funds together, and then somebody called a general partner, a GP, these are the people with all the real estate experience. They've got the track record, the teams, all the connections, they've got the deal flow. What they'll do is the GP will acquire a property. These investors will bring their funds on the equity side, it's called private equity, and they will take down this property. And the GP will work to ensure that the investors earn a return. And again, these investors are benefiting from so many benefits, tax benefits. We didn't even talk about tax benefits. I could go on for 20 minutes, or if not more, just about the tax benefits of real estate investing. So these investors don't need any experience in real estate. They're able to invest in these large deals that have the stability, the cash flow, the better debt terms, tax benefits, all that sort of stuff. And they can roll from one property to another property, and then there's a different structure called a fund. But I would seriously consider, if you are an accredited investor, so if you're making $200,000 a year or more, or as a couple $300K, or if you have $1 million of assets, not including your principal residence, I would take a look at this syndication structure. It's pretty cool. And if you do have questions about that, you can head on over to callseth.com, and we can chat, and I can share some of the stuff that we are working on right now. So I hope this answered your question, how you invest in a hot real estate market. Well, it's just using some creativity and finding those opportunities that everybody is passing over, whether it's through renovation, whether it's through rezoning, severing the lot, knocking down a property and custom building a triplex, like the example I mentioned. People are making money in these hot markets, but you can't just buy a property and hope it goes up in value, because people get in trouble that way. So if you do have questions about investing in real estate or investing in multifamily real estate through syndication, go to callseth.com, and always happy to chat. Thanks a lot and have a great day. Talk to you soon.